Yeah, so I guess let's have a little quick chat on the next piece here, the capital markets piece. The investment market is projected to recover in 2025, which I think you can already see that taking place. Like, see, the MLI Select stuff has been really driving it and keeping cap rates compressed for the multifamily side, but I think you're seeing other asset classes recover as well. Momentum is building in the Canadian commercial real estate sector due to improving sentiment and recent interest rate cuts. And investment volumes for 2025 are on track for 45 billion, with a revival expected in 25, potentially reaching as high as 48 billion. Alternative assets are anticipated to attract robust investor interest, and institutional capital is poised to return, ideally fueling some liquidity in the market. And I do think that once we get off of this kind of political roller coaster that we've been on the last little bit, where policies keep bouncing back and forth, that should help some institutional capital as well, because we did see a big outflow of institutional capital in Canada.
Yeah, institutional capital likes boring, right? Boring is good. Drama, political crisis.
Even boring. Like, it can be exciting, but kind of like predictably exciting. I guess.
Sorry. Boring is maybe not the right word, but stability, let's say, right?
Yeah. So there will be ongoing price discovery in early 2025, which I'm glad they acknowledge. Like, they believe that we will still be needing to figure out what's happening up or down. Probably like a little bit of down, a little bit of up. What's that? Sometimes maybe good, sometimes maybe blank.
Sometimes maybe good, sometimes maybe shit.
But particularly for certain asset classes, a more stabilized pricing environment is expected by mid-year, resulting in increased transactions. So again, and you're seeing this in the res side. We're going to cover Korea stats on our next episode, but like, people seem to buy when they start to think prices are going up. Everybody says they want to buy the bottom, but they don't actually. They want to kind of be like getting in as price increases are just starting again, right? So nobody wants to be buying on the way down into the bottom. They all seem to want to be buying kind of on that tail end where they can see the predictable, we're stable, there's some mild growth happening. This seems safe. I can step into this.
Yeah, exactly. Okay, so just a couple key points that I took from this piece on capital markets is that early 2025, we'll see a bit of price stabilization, expected probably mid-year. Again, and that will drive more transactions. The Class B office sector is likely in trouble. These assets will face prolonged pricing challenges due to increased costs, weak demand. Could result in taking years to stabilize, essentially fill one of these Class B. Usually Class B kind of suburban, older buildings. So though if you're an owner of Class B, you're likely in for a rough road ahead.
Roads, where we're going, we don't need roads.
Sector-specific trends, let's talk about office. There's a growth mindset returning with demand and a big push for sustainable spaces. And Dan, as you said, kind of that like live-work balance in the office. Retail, limited supply is pushing expansion into secondary markets, which is good. And industrial, again, roller coaster for the last couple of years. It'll normalize this year. The overall economic outlook with immigration limitations, temper economic growth forecasts, and Canada's long-term outlook, it still is favorable, and it's looking good for commercial real estate overall.
Yeah, so they do have a piece here, and this is kind of this is one of my favorite charts, actually, to be honest with you. It reminds me of
you've said that twice.
Yeah, not.
This is amazing. People love this.
It's not the one that I have up on my screen right now. It's the one
that
Yeah. So they have this piece here about cap rates, right? So I like it. That's why it's one of my favorite charts.
Well, hey, we love a good cap rate. So why don't you tell us what CBRE has to say about them?
Yeah, so they basically say that cap rates in Canada are expected to start going down slightly in 2025, which it kind of surprises me based on the chart that they've presented, but after they've been going up for the past few years, right? So remember, if cap rates are going down, that means valuations relative to income are going up, right? Because they're lower return on the asset. Some areas are already seeing small decreases, helped by expected lower government bond rates, though uncertainty in global markets could change this. So any of the downside that they're seeing could potentially come from reduction in the Canada bond yield. And the chart that they show basically charts your Canada 10-year bond yield alongside national average of all properties cap rate. And right now the spread is about 355 basis points. The 20-year average spread is about 384 basis points. So we're kind of in that, like, in that
Almost
channel.
back to average. Yeah.
But the
Yeah.
scary part is if you look at like the tightest spreads historically, it's like right before a huge recession, right? So 1990, early 1990s, it was 211 basis points. 2006, it was 231 basis points, right? And during COVID, or 2022, it was about the same. I think it was 250, 300 basis points. So it was kind of, the writing was on the wall there, right? So different types of properties will see different changes. Obviously, office buildings will likely see lower values, while apartment buildings might need to offer higher returns to attract investors. Maybe not if CMHC keeps just pumping that full of cash and people are still lining up to go levered long on multifamilies. I still don't know how that one's working now. I mean, I thought it was a good play when we were talking about it a lot on the show like a couple of years ago. It's starting to, I'm not saying it's not a good play, but it's definitely, the risk profile of it has grown significantly between that point when we first introduced it to now.
Yeah.
And this is obviously likely due to the array of favorable financing options for the multifamily asset class that they've observed in this report. Shopping centers with strong anchor stores like grocery and legacy big box stores are becoming more and more popular with investors, and increased competition for these properties will likely push returns down slightly in 2025.
Yeah, really, really interesting stuff. Okay, let's move on to the next piece here, Dan. Debt markets. Now, this is important because debt makes the world go around. And if money is too expensive, the ride stops, or at the very least slows down. Now, CBRE has a bunch of info on debt markets, so we condensed it, and here are some of my main takeaways from this part of the report. The first is on increased debt availability. We've said time and time again, the reason why we're seeing lower housing starts and less people doing even small cap development is because it is so hard to get money these days. But lenders are expected to provide more financing in 2025, although CBRE predicts they'll still remain selective. This includes expansions into previously challenging sectors like retail and office. Credit spread normalization. Remember the two cars rented. The credit spreads are expected to contract toward historic norms, so back to a bit of regularity, with top assets maintaining current levels while wider spreads begin to compress. Here's one that we've been talking about for a while, Dan, is more conservative underwriting. And lenders are adopting more cautious approaches by factoring in larger vacancy, right? We just did that episode on with ULI and PwC where we looked at office vacancy across the country, and where we look at stuff like 30% in Calgary and mid-20s in Edmonton, and even a low office vacancy at over 10% in Vancouver. Underwriting is going to get tighter, and that's one of the things that's going to change is vacancy provisions. Making more cautious income projections and valuations as well. And this practice should also be adopted by all investors, not just if you're buying a Class A office space, but if you are buying a Class B duplex in a secondary market. I urge you to maybe increase vacancy, be more cautious about income and the valuation of your asset class, of your asset, sorry.
Yeah, I'll jump in on that as well. Like we've, in realist.ca, which by the way, we do have a monthly option for people who aren't looking for one-on-one coaching and just want to hop on, get a good group setting right now. Because we kind of tapped out how many students we're able to take on in a one-on-one setting. So give us a shout if you're interested in that. But we regularly go through reports like this, especially the ones where what's happening with rents and with vacancy rates. And while I haven't seen vacancy climbing yet, and it would be like, our housing market is so oversubscribed that I don't know if I can imagine vacancies really, really jumping up if rents continue to come down. Because so this is the thing. So, we went through it with a lot of the realist.ca students who are looking at these rental reports, and everybody starts changing their models now, saying, okay, well, what if rents just went down 2-3% in some markets, right? In Toronto, and on a per square foot basis, maybe they're not, but Calgary, you're seeing some rents dropping. City of Toronto, you're seeing a little bit, but the unit sizes are shrinking, so it's kind of hard to tell. But you put that into your model and see, and now all of a sudden your income scenario changes, and the model becomes less optimistic, and deals are becoming harder and harder to pencil, even though prices are getting better and rates are getting better. And so there's so many variables that happen in this whole thing, and it's like, okay, well, now you have to model it. When do I think rents are going to recover, or do I think they're going to be flat for a period of time, or what's going to happen there? So for the asset class portion that they have in here, we'll start with the office market with the 310s trends to watch that CBRE has identified. So number one, tenants now prioritize experience over just quality, seeking spaces that offer a lot more than traditional offices, right? Because they really, I mean, look, your corporations that employ a lot of people, they need to compel those people to come back to the office if they feel those people are more productive in the office, which I think most corps seem to feel that way. And so they need to have good office space to do that. We're seeing limited new construction that will help stabilize the market, because we remember, like, at least in Toronto and a couple of other cities, I know, like, every city that we've been to in Canada now, they all have a bunch of brand new office buildings, right? Like, I feel like there was definitely a bit of a wave starting pre-COVID. People were fired up to put offices in, and then it was like, oop, that was a bit of a wild decision heading into this change. But this might create a shortage of modern office buildings later if we're not continuing to fill up that pipeline. Vacancy rates are expected to peak in early 2025, with improving market sentiment signaling a potential recovery, which I would argue is maybe a little bit early, but I do expect it to take place next year. Like, even in a recession, I think you start to get rates come down, people re-enter the market. That'll happen with rents too. That's kind of what I was saying with the vacancy rates. Offices would be the same. It's like, man, you and I would rent an office if the rates became compelling for us again, right? So it all becomes a function of that.
We've been to meetings downtown where we've, I'm not going to name the names, but there's been a few offices that we've walked in and they've taken, 50 or 100, 200,000 square feet. And half of it, or like a third of it, is empty. And we're like, when did you guys move in? They're like, oh man, we got a killer deal during COVID, like pennies on the dollar. And, but yeah, a growing divide does exist and is continuing to grow between the premium and standard office buildings as tenants continue to prioritize quality. So CBRE's 2024 survey shows that 59% of respondents plan to upgrade their space, with even Class A tenants moving to AAA buildings. So that's a lot of tenants that plan to move to better spaces. And I'll just provide a quick piece of context here. So Class A offices are prestigious buildings with premium finishes, modern systems, prime locations, and those obviously command above average rents. Wherever you are in Canada, think about the best office space in the most downtown of the biggest city that you're close to. That is likely a Class A, or maybe even a Class AA or AAA, because office buildings are classified as A, B, or C, but broken up into, when you get into the A, it can be A, AA, or AAA. Class B offices offer kind of average rents and finishes, usually not in the best part of downtown, or maybe removed from a little bit outside of downtown. And of course, Class C buildings just are basic functional spaces at low or below average rents, often with older infrastructure and less desirable locations. So long story short, we'll see premium locations maintain low vacancy rates, while other buildings are going to have to figure out a way to upgrade to remain competitive as the quality gap widens.
Yeah, that's like kind of a fascinating piece of the puzzle, right? Is the quality gap, because I think you're seeing that take place in the res space as well. Like, and I would say, like, I've always catered to more the lower end of that market, because I just take pride in being able to provide affordable housing. I want to be landlords to those people that a lot of other people don't want to be landlords to. But you're seeing a similar thing take place in residential, where you have this affordability, like this top end affordability, which is like home ownership, and so basically there's people who are leaving homeownership, they have a ton of money saved up, or they're giving up on homeownership. They have a ton of money saved up. They can usually afford like a full mortgage, et cetera. And so that kind of pulled your res rental market up a lot from the top as well. So you can kind of see that quality gap existing in the res space.